The put call ratio is fucked. Essentially, it's not usable anymore to gauge sentiment and to gauge potential reversal points in the overall stock market like it has been in the past. And in today's video, we're going to talk about why that's the case, and we actually have some really good data to back that up that tries to explain, or hopefully can explain, why this is actually happening and why it doesn't necessarily matter when we see spikes like this on the put call ratio up over 2, which is, looking back, the highest level we've seen since the COVID lows, which you'd think, oh man, like we're in panic mode, market must be crashing, but yet it's not. It's kind of consolidating, it's in between a range, it's not at lows, it's not at highs, it's just kind of hanging out. So I stumbled across this article from CBOE, and this is where you're going to find a lot of this options data, and you can get put call ratios from CBOE site. They have subscriptions and whatnot, but this article from Henry Schwartz actually dives pretty deep into this whole deal, and we're going to kind of unpack this here in today's video, and it shouldn't be super long. But what we've seen is a very high put call ratio. I'm not going to read off every paragraph, okay? I'm going to summarize this after I just read this a couple times through to get a good feel for the understanding as to what's actually going on here. So this is one of those things that has really kind of confused me this year, and now, while I will still watch the put call ratio, I'm not going to put much weight or as much weight behind utilizing the put call ratio in my day-to-day. Because what we see right here, this is going back to 2018 on the left, the put call ratio generally hangs out or has an average around this like 0.6 mark, which would be about 0.6 puts being bought for every call. And you'll see different put call ratios, whether you're looking at equities, indices, you'll see different numbers here, but the general idea is that you want to look at whatever put call ratio you're looking at, zoom it back out, like get a relative sense of the range of this. And so based off of this put call ratio that we're looking at right here, it goes back to 2018, you pretty much see that these big time spikes in late 2018, right? We had a 0.75 on the put call ratio. We had a 0.83 based on this spike right here. That was the COVID crash. These were both lows in the stock market. Like, we had a pretty substantial move down to lows, and then we ultimately bottomed shortly after or around those times of those high spikes. And then we started to kind of turn back to the upside. And so using data like that, you would think to yourself, oh, cool. Like, if I look at the put call ratio, like, yeah, maybe it's not a great day-to-day indicator. But if I see the put call ratio spiking up and the market's dumping off, like, this might not be a bad time to buy. There's a lot of panic, there's a lot of fear. If I can kind of weather this storm, we might be closer to a bottom right here, right? Or if we're just slowly selling off where the put call ratio isn't really spiking up, that slow sell-off could continue until there's a capitulation event or until we kind of have a really big spike on the put call ratio. And that's what historically we've been able to utilize the put call ratio for. But this year, not so much, because we right now have the highest on this example of put call ratio, the highest we've seen in the past 4 years. Yet we're not crashing. Yeah, we're in a bear market, but we're not crashing. And the explanation as to why is a bit more in-depth than you might think. And unfortunately, it's like not as interesting as I wanted to see. So I was kind of disappointed in reading this, but it makes a lot of sense and it's useful stuff, because if we didn't know this, we'd look at the put call ratio and go, oh my gosh, like, we're going to have a really big rally soon because everyone's socked into puts. Like, generally speaking, like, the sentiment is still there. It's still bearish, but it's not as bearish as the put call ratio is making us think, right? Okay. So generally speaking, like we discussed, put call ratio averaging 0.6, whatever, which, indicates a bullish bias in the stock market, which we've talked about before. Generally, there's a bullish bias. This chart right here is kind of unpacking the weird action this year where the S&P over this span from October has actually gone up, yet the VIX has gone down and the put call ratio has gone up. Usually you don't see that. Usually when the put call ratio goes up, the VIX goes up and the S&P goes down. We are seeing like a complete opposite of that. So we're not seeing what we usually see. Now, of course, day to day, like, it doesn't necessarily matter, but we're looking over weeks and months, and over weeks and months, these trends continue and they're like completely, going against the grain of what we've seen in history, right? So it gets us like, okay, like, what's actually going on? Well, a lot has to do with interest rates, and it all boils down to the Fed, right? We all come back, oh, the Fed is raising rates, right? And so, what does it actually mean? Like, the Fed raising rates, like, what is that actually doing? Well, we're going to unpack that here in a second. Here's a quick chart covering that put call ratio and showing you that for whatever reason, which we're going to unpack, and we're going to get the answer to that in just a second. Wednesdays, these are spikes. This is the past like 6 months. These are all Wednesdays, or a lot of these spikes are Wednesdays in the market. And you're like, okay, why is this happening on Wednesday? And if you were to go back on the put call ratio this past week, what do we see? Well, we see a massive spike on Wednesday. So we see it yet again. Right? It's okay. Like it's continuing to happen. The big spike right here on December 21st, that was a Wednesday. These put call ratios over on TradingView, up over 1.5 on Wednesday, up over 2 on this past Wednesday. Like, oh my gosh. Like when we see that, we're like, oh my gosh, that's crazy. It's not as crazy as you think because there's a reason why it's being done on Wednesday. So this chart even goes into some of the timing of it, the exact timing of this stuff. What you're going to see in this example is that what's actually being traded are deep in the money puts, okay, where the volume actually exceeds the open interest by a crap ton, okay, which eliminates the possibility of closing activity on those options, okay? Now, this might be confusing, especially if you're not sure, what options are and how this stuff works. If you have no idea what options are and how this stuff works, I would highly recommend learning options and how they work. There's a video on this channel. There's other channels out there you can watch too if you don't like me. But I explain in depth like options for beginners. Like if you go onto my channel search, you can find the video and we go over like what calls are, puts are, how this stuff works, like what it actually means when you're exercising a call, exercising a put, buying a call, selling a put, all these different things, okay? So in this example, the most active contract is the January 23rd, 125 Amazon put. Now you think, okay, like it's just a contract, right? Whatever. Now we're filming this video. It's like about to be January. It's essentially January, right? When you're watching it, it probably is. So AMZN, if I go to Amazon and look at the chart in Amazon, Amazon's at $84 is where it closed at on the last day of trading for 2022. So 125 strike is all the way up here. It's above the 200 moving out. It's way up there, which means this is a deep in the money contract, okay? This contract on this specific day or this example saw 99,000 contracts trade compared to a 9.2 thousand open interest at the time, or open contracts or contracts that were open at the time. So the open interest the next day wasn't changed. This is just like it's kind of a one and done. It's happening on this Wednesday. Like what's going on? So you'll see the same thing occur, or a very similar action occur across other stocks. In this case, they have C, TSLA, BABA, all these different stocks. Cool, great. But can we get a better understanding as to why this is being done? Yes. Before we get there, you're going to see that this is a chart going back those same 4 years. Okay, equity option market share by option type. So like what's mostly being traded? Out the money calls are trading, or they had been trading, especially in 2020 and 2021, a lot more. And so that still, even today, out the money calls still trade about 38.5%. Okay, now that could be short term, that could be out the money calls for 2 years out. Like it doesn't necessarily matter, but out of the money calls, okay, are the ones that are trading the most. And that makes sense, right? We generally have a bullish bias, and on dips in the market, people generally, right, want to buy, calls for, later dates as they think the market will go back up, yada, yada, whatever, right? It doesn't have to be that far out the money, right? It could be, 10, like let's say you're buying an Amazon call and you buy an Amazon's at 84, you might buy an Amazon 90 call for 2 years out. And you're just or you're betting that Amazon will be over 90, in 2 years, and ideally, right, that is over 90 by a substantially, larger amount than what you're paid in option premium, intrinsic value. Again, that we cover what that means. If you don't know what that means in that options for beginners video, I highly recommend that. So even this past year, right, you're seeing out the money calls decline. So it makes sense, right? We're seeing a decline in out of the money calls because people are skeptical. They don't, not sure how this bear market's going to go, how long it's going to last. And then you see out the money puts kind of perking up. Okay, makes sense. Like, so people are still generally buying more puts than calls right now compared to where we were, a year or two ago. Like, so really like 2 years ago, like we're generally seeing more puts, right, relative than we have been, and less calls than we have been, but still more calls than puts. But down here, this black line, this in the money puts were really not something that traded a ton until the past year, and they're really increasing in terms of their trading. So these next paragraphs right here explain essentially the whole deal. I'm not going to read them word for word. I'm going to kind of summarize them, but if you want to screenshot the video, you can screenshot this, or this is essentially where you're going to find the meat of the answer. In the money contracts, okay, what you'll find is that when it comes to calls, what we've commonly seen in the past is deep in the money calls, when you exercise them ahead of a dividend date, this can create large open interest, and this is immediately assigned by another party. This is done because it might actually be worthwhile to have the shares of the stock that would then pay you a dividend if you hold them by the ex-dividend date versus just the options that are deep in the money, right? It might make more sense to exercise those options and then grab that dividend of the stock, because now you're going to have, if you exercise options, you'll have a ton of shares because you're essentially buying the shares at the strike price. You'll have a ton of shares, and if you have all those shares for the dividend date, great. Now you get a big dividend check coming in the mail soon. Cool. But on this side, it's puts. And the answer isn't as clear as to like why, but it comes down to something called carry cost. And as interest rates have gone up, carrying costs have gone up substantially. So when exercising these positions, okay, if you exercise, or if you were to come in and buy in the money puts, like you are buying the right to sell, in this case, Amazon, right, in the example, at $125 per share. But if you immediately or very, very soon after exercise, if you had a position underlying in Amazon, then you're going to be selling your shares at $125. Or if you don't have a position, you're going short on Amazon, but your average on that short is $125. Now you're still paying the premium of the option. So it's not like, oh my gosh, like they're making tons of money because of this and this. They're minimizing themselves on the carry cost by holding. Like these deep in the money contracts make less sense to hold because of the rise in rates and that carry cost, essentially is what it means. And so exercising these deep in the money contracts essentially immediately is what's going on. And when you exercise a put on a Wednesday, it will result in the sale of the stock the next day, which is Thursday. And then 2-day settlement roughly gets you to Monday by the time it settles. So it's just setting you up for like, okay, by next week, by Monday of next week, this will all be done and it will go through. And that's why it's happening on Wednesday. Okay, so hopefully that kind of makes some sense. So that's like, when we come down to the core, like that's what's happening. Like that is what's happening right now. And that's like the biggest takeaway from this article. So they unpack, okay, great. How can we kind of smooth some of these lines? Because like this is not as useful anymore, right? If we are looking at this. Well, you can take different looks at the put call ratio. For example, all markets equity non-in the money put call ratio. So this will essentially get rid of all those in the money puts that are being, shown, because the volume, the substantial volume, like if you eliminate all in the money puts, yes, some of them are going to be actual traders, actual people who are going to hold those, who want to hold those, who are betting on downside, but a lot based off of these crazy high volumes, a lot are going to be kind of like these people who are immediately exercising, or the big money, the market makers, whatever, who are immediately big players who are immediately exercising these puts, okay? And so if you eliminate the non-in-the-money puts, yeah, maybe are you missing a little bit to this puzzle? Like, sure, but you get a chart that looks like this. And what it tells us is actually that the put-call ratio is somewhat equivalent to where we were late 2019, early throughout 2019, and that COVID spike. But we didn't see you know what I mean, the COVID spike here, you know, it wasn't anything substantial. And again, because you're probably missing out on some of that in the money put action, which did also spike during COVID. Go back to this chart up here. In the money put, go back here. Yeah, in the money puts did spike. And at the time, were probably more people betting on the downside in the market with a little bit of security by in the money puts. So it's not perfect. It's tough. It's kind of a pain, but that's what we're at. You can also look at put call ratios, open close file data. Why would you do this? It's because the general accounts that are involved in the exercising are not customers, so to speak. And so this chart you can look at, this is the past 6 months, you get a different shape. Yeah, there's been some spikes along the way, but it's not as aggressive of a move to the upside that we've been seeing as of late. And then last but not least, there's the small trade. So this is going to avoid a lot of those large scale orders, and it's going to avoid those large scale exercising orders as well. And this is the small trade put call ratio. So there's other ways to look at it, but what you're going to find in looking at it these other ways is that these charts are not as impressive. It's not the same as this right here that we've been watching the past year. It's not the same as this crazy spike in the put call ratio here on it's not as interesting as we might think. And that's all due to essentially these immediate exercisings of these deep in the money puts because the carry cost with rising rates is no longer worthwhile. So hopefully that somewhat explains what's going on with put call ratios and why they're not as useful as they have been. If you got something out of the video, thumbs up button. Consider sharing this video because I think a lot of people are going to have this question. And now also, you'll see it from me. We'll look at it, especially on Wednesdays on our live streams and stuff. But it's not. It's if you see someone talk about the put call ratio and they're pulling charts like this, and they're not, issuing a caveat, or they're not looking at other charts that we looked at, like the small trade and the put call ratio without the deep in the money contracts. They don't know this is going on, which is fine. And, this is good to kind of spread this information because people need to know this stuff if they're using this as an indicator, because it has been a valid one in the past. But it's not what it used to be. So hopefully that makes some sense. Thanks so much for watching. Thumbs up button, consider subscribing, and I'll see you guys in a future video. Peace.